We are joined by Hugh Albert Johnson, who's the chairman and chief of Hugh Johnson Advisors. Good morning, Hugh. Thank you for joining us on this edition of Market Cafe. I'm Cheryl on the other side. To talk first about the market movement, would you term this as actually a dead cat bounce? It's not a bounce as such, but it's highly volatile. What do you make of the market moves?
Well, I think you hit the nail on the head. This is a highly volatile and uncertain market. You can't as yet trust it. You know, you have one good day, and everybody knows that periodically we get one good day, and it's unfortunately followed by a day which is not so good. This is going to very much depend on, of course, the news on coronavirus, and if we start to see or we continue to see an increase in the number of cases in the U.S., in other words, we don't see any light at the end of the tunnel, then you're likely to see continued volatility, which means more up days and more down days. I would describe the U.S. equity market environment as right now probably going to turn out to be trendless and volatile, and that's actually good news because I'm not saying we're going to go down significantly from here. I'm not saying we're going to go up significantly from here. I'm telling you that I think it's going to be very trendless and very volatile.
Good morning, Mr. Johnson. Thanks for joining in. You know, one question I have is revolving around gold. Why are we seeing gold constantly slide? If you look at it, traditionally it's been holding up over the last year as a pretty solid hedge as well and a really good safe haven asset. Doesn't seem to be the case this time. Amid all this volatility in equities and oil, you'd think that investors would really flock to gold. But that just doesn't seem to be the case as far as the numbers go. So do you have a take on why that might be happening?
I don't have a good take except to say this. You're absolutely right that if the U.S. were entering a bear market, in other words, if in February we saw the peak in the bull market, the start of a bear market that would be in anticipation or accompanied by a recession, you'd see gold, of course, not only doing well, but doing well relative to the S&P 500. Gold is a great investment when you see the peak in the U.S. stock market. So, quite frankly, I don't know the explanation except to say this. If you're looking for some encouraging signs in the financial markets or the performance of the U.S. financial markets, the poor performance of gold is certainly a positive sign. It sort of suggests that maybe indeed, just by some luck, that we're not starting a bear market. This has only been a very severe correction in an ongoing bull market. It's hard to bring that case up, but quite frankly, it's a positive sign to see gold underperforming.
And so, you know, let's say if you're an equity investor right now, do you stagger and invest? Do you sit back a little while and just wait this one out and kind of watch what's happening? Or do you think if you're someone who's a cash-rich investor, this is a really opportunistic time and perhaps you should start in a very slow fashion deploying funds? What's your personal strategy here?
Yeah, that's a great question. And the reason for that being such a good question is there's no question that we moved from in January being overvalued in the U.S. markets with not much upside potential. And now, as I do my numbers, I don't think I've seen a time like this over the course of the last, say, 5 to 10 years, and I include the 2008 crisis. I've never seen a time when the stock market represents such a significant opportunity. In other words, is so meaningfully undervalued with such meaningful upside potential. So that would tell you that you should start to buy some now. But again, this market is very untrustworthy, so I wouldn't plunge in. I might buy a little bit, but I'd certainly be wary because you're going to be faced with maybe an opportunity, but at the same time a market that as we look out over the next couple of months is going to be somewhat trendless and continuously very, very volatile. It's not going to be fun.
Right, Hugh, actually staggered investment is what actually most investors, most experts are also pointing towards considering the volatile market situation. But Hugh, what would you term this particular downturn in the markets? Is it similar to 2008? Would you stick your neck out now and say that is this similar to 2008? Some of the experts are actually coming out and saying that right now when at the start of the downturn they actually said no, it doesn't look like 2008, but now it is seeming more like it.
I think it seems very much, first of all, I think the case that there's going to be a global recession is extraordinarily good. we would put global growth at 1.5% positive in 2020, and that's a recession. I also think the U.S. is going to be going into a recession. We'll have 1, 2, or possibly 3 quarters where we'll have the U.S. economy contracting. Under those conditions, stock market is likely to go down. The only qualifying thing I would say is that we've gone down so far, so fast, in such a short period of time, that I think most of the downside is probably behind us. And so therefore, I think the market is probably going to end up being, once again, trendless and volatile. All of this being a part of the end of that great bull cycle with that great economic recovery, the longest in U.S. history. That's over. We're now in a bear market. The bear market will be accompanied by a recession, but I think most of the downside in the U.S. stock market is probably behind us. So look for not much upside from here, even though it's very, very good value. You're going to have to wait for that, and what you're going to have to wait for is good news on coronavirus. In other words, some indication that there's containment in the U.S., and once we see that, then the markets will be start to recover. But you're going to have to be very patient right now, even though the opportunity is great and the valuation's extremely attractive.
We leave it at that. Thank you for joining us this morning, giving us your